Welcome to Talk Tickers, your shortcut for understanding crucial earnings calls.
Today, we're diving into the PNC Financial Services Group's first quarter 2025 earnings call.
Let's get right into it. What were the headline numbers?
Well, PNC reported a pretty strong first quarter, actually. Net income came in at $1.5 billion.
Okay.
That works out to $3.51 per share. Now, loan growth, it was tough across the industry generally.
Yeah, we've heard that.
But PNC, they managed a notable 3% increase in their spot C&I loans.
C&I being commercial and industrial.
Exactly. Commercial and industrial measured right at the end of the quarter. That suggests some decent momentum there.
Right. And what about the rest of the picture? Revenue, expenses?
Revenue was down a bit linked quarter, mostly due to fewer days and some seasonality, but expenses looked well controlled.
Good.
And importantly, their net interest margin, NIM, actually expanded slightly.
So despite those industry headwinds on loans, they seem to be managing okay. What's the outlook?
They're sticking to their guns. They expect to deliver positive operating leverage for the year.
Meaning revenue growing faster than costs.
Precisely. And they're forecasting record net interest income for the full year 2025. Plus, credit quality is holding up well, and they're still building capital.
And returning some to shareholders, I assume.
Oh, yeah. Significant returns through both dividends and share repurchases continued.
Okay, solid overview. Let's dig into the balance sheet details now. What moved?
Sure. So average loans over the whole quarter dipped by 1%, down to $317 billion. But as I mentioned, the spot number, loans right at quarter end, that actually increased by 1% or $2 billion compared to the end of Q4. So they finished the quarter stronger.
Interesting distinction. What about the other side? Securities, deposits?
Investment securities ticked down to $142 billion.
Yeah.
And deposits also saw a 1% decline, landing at $421 billion. Some of that's probably just seasonal noise.
Right, seasonal flows. And capital, how does that look? Always critical for banks.
Yeah, looking pretty strong there. Tangible book value per share, a key metric, jumped 5% from the last quarter.
Wow, 5% linked quarter.
Yep, and 17% higher than a year ago. It hit $100.40 per share.
That's a solid increase.
And their estimated CET1 ratio, that core capital buffer, was 10.6% at quarter end.
Which is comfortably above requirement.
Definitely. Even including AOCI, which can be volatile. It was 9.4%. And they returned about $800 million to shareholders this quarter alone.
Okay, so the balance sheet looks robust. Let's circle back to the loan portfolio. You mentioned that C&I growth.
Yeah, that 3% spot C&I growth was really the standout figure on the loan side. It's the biggest jump they've seen since Q4 2022.
What drove that? Just businesses drawing down lines?
It was a mix. Higher utilization rates. Yes, businesses using more of their existing credit lines. That rate climbed to 50.3%, up 80 basis points.
Okay.
But also solid new loan production across different categories. So new business coming to the door too.
But average loans were still down slightly overall.
Right, because that C&I strength was partly offset by, well, continued runoff in their CRA office portfolio.
Community Reinvestment Act properties.
Exactly. And also lower consumer loan balances dragged the average down a bit.
Got it. Okay, shifting gears to investments and interest rate management. What's happening with their securities portfolio and swaps?
Well, the average investment securities balance decreased. Basically, prepayments and maturities were happening faster than they were buying new ones.
And the yield on those?
Pretty stable at 3.17%. About 20% of that portfolio is floating rate.
And they use swaps to manage rate risk, right?
They do, quite actively. They have $39 billion in received fixed swaps, and the average rate they're getting on those has actually increased.
Helpful in a potentially changing rate environment.
Absolutely. And they've also ramped up their forward-starting swaps. Those are swaps that kick in later. Added $9 billion, they're bringing the total to $20 billion, extending out through 2026.
So locking in rates further out.
Essentially, yes. It helps lock in the benefit of fixed-rate assets repricing higher and reduces their sensitivity if rates were to, say, fall later on.
Smart planning. All right, let's talk deposits. The other side of the funding coin, what were the trends there?
Average deposits dipped 1%, like we mentioned. They pointed to seasonal factors for both consumer and commercial.
Any divergence between consumer and commercial?
Actually, yes. Consumer deposits were up 2%. It was commercial deposits that declined by 2%, driving the overall average down.
Interesting.
They also intentionally reduced their reliance on brokered CDs. That's part of their plan. And the rate they paid on interest-bearing deposits actually came down slightly to 2.23%.
And their deposit beta, how sensitive are their deposit costs to market rates?
The cumulative beta was 51%. So, for every 1% move in benchmark rates, their deposit costs have moved about half that, roughly. Shows some pricing discipline.
Okay, let's pull this together on the income statement then. How did the revenue and expenses flow through?
Net interest income, NII, was up a strong 6% compared to Q1 last year. That was driven by, higher NII itself, but also some solid fee growth year over year.
And expenses.
Non-interest expense was up 2% year over year. They flagged increased business activity, tech investments, and higher marketing spend as the main drivers.
But linked quarter compared to Q4.
Linked quarter. Total revenue actually decreased 2%. That was mainly the lower day count and seasonality we talked about.
Okay.
NII also dipped 1% linked quarter. But that was partly cushioned by lower funding costs and that asset repricing, which helped the net interest margin tick up 3 basis points to 2.78%.
So NII expanded despite lower NII sequentially.
Correct. Fee income was also down 2% linked quarter. Some bits were up, like asset management and brokerage.
Right.
But capital markets, advisory fees, lending, and deposit service charges were lower. Mortgage revenue, however, did increase.
Any noise in the other income line?
Yeah, a bit. Other non-interest income included some negative adjustments related to Visa derivatives, just something to note.
And on the cost side, linked quarter, you said expenses were well controlled.
They were. Non-interest expense actually declined compared to Q4. Some of that was because Q4 had some one-off asset impairments, plus seasonality helps in Q1 sometimes.
And they still have that cost-cutting program, right?
Yep, the Continuous Improvement Program. They're targeting $350 million in cost saves for 2025. The plan is to reinvest those savings back into the business, particularly technology.
Makes sense. Now, the crucial part for any bank, credit quality. How are things looking?
Overall, pretty stable and strong, actually. Non-performing loans were basically flat quarter over quarter.
That's good news.
Delinquencies ticked up just slightly, but that included some noise from forbearance activity related to the California wildfires.
Okay, understandable. What about actual losses, the charge-offs?
Net loan charge-offs actually decreased. That was mainly due to lower losses in that CRA office portfolio we mentioned earlier. They did caution that the level will likely vary quarter to quarter, though.
Naturally. And the allowance, the rainy day fund for loans.
The allowance for credit losses stood at $5.2 billion. That's about 1.64% of total loans.
How does that reflect their economic outlook?
They mentioned it reflects slightly increased weighting towards downside economic scenarios in their models. And interestingly, they've factored in some consideration for potential tariffs.
The tariff question. Are they quantifying that impact yet?
Not really changing estimates yet. They said they're actively assessing it, but things are just too fluid right now to put hard numbers on it.
Fair enough. Okay, so looking ahead, what guidance did they give for the rest of 2025 and for Q2?
For the full year 2025, the guidance is largely unchanged from before. They expect average loans to be stable overall, but spot loans to grow 2-3%.
Okay.
NII up 6-7%, non-interest income up around 5%, leading to total revenue growth of about 6%. Expenses up only about 1%, and the tax rate around 19%.
Pretty positive outlook overall. Any caveats?
The main one they flagged was that non-interest income, particularly fees, could face some pressure if this tariff uncertainty continues or escalates.
Right, that makes sense. And for Q2 specifically?
Compared to Q1, they're guiding for average loans up about 1%, NII up 1-2%, fee income up 1-3%. Other non-interest income somewhere between $150 and $200 million.
So total revenue up slightly in Q2?
Yeah, up about 1-3% sequentially. They expect expenses to be stable compared to Q1, but net charge-offs to tick up to around $300 million.
Why did the jump in charge-offs?
Mostly timing, they said, related to expected charge-offs in that CRA office portfolio landing in Q2.
Got it. So beyond the numbers, what were the big discussion points on the call? What were analysts asking about?
Well, definitely the impact of that tariff uncertainty, how it might affect client activity, recession risks, the usual macro concerns.
Sure.
Lots of questions trying to unpack that C&I loan growth. Was it really tariff-related stockpiling or more general precautionary borrowing or just underlying strength?
The why behind the number?
Exactly. There was also talk about the pipeline for capital markets and M&A. Harris Williams, their advisory arm, apparently still has a robust pipeline.
That's a positive sign.
Also discussions around expense leverage. Could they cut more if things turn south, like in a mild recession? Where's the efficiency potential? Other things included potential for more loan growth if credit spreads widen. The recent appointment of Mark Weidman as president, though they stressed no change in strategy there.
Okay.
The outlook for NIM, they hinted it could approach 3% by year end, which would be quite strong. Capital allocation priorities, especially share buybacks, expect more, but still focusing on building capital ratios.
What about their national expansion?
Yeah, they highlighted progress there across different business lines. And finally, lots on rate sensitivity, how they're managing it, and of course the regulatory environment, always a factor for big banks.
Lots to chew on there. Okay, let's transition to our final segment. Time to put on our, shall we say, creative thinking hats. Remember, this is absolutely not financial advice, just a thought experiment.
Right, disclaimer firmly in place.
Based on everything we've just discussed about PNC, what's a wild yet maybe plausible trade idea that springs to mind? Like something you might hear pitched internally.
Okay, here's one angle, playing on a couple of themes we hit. You've got PNC showing that solid C&I loan growth, right? Some of which might be linked to companies needing more working capital because of supply chain shifts or tariff worries.
Okay.
At the same time, the capital markets environment is still a bit choppy, maybe uncertain. So what if you considered a pair trade? Go long PNC, betting on continued loan demand, especially if businesses need funding domestically.
And pair it with?
Pair it with a short position in, say, a basket of high-yield corporate bonds, or maybe companies particularly exposed to international trade disruption.
The rationale being?
The thinking is PNC could benefit from that potential increase in domestic lending if capital markets stay volatile or if tariffs bite, making bank lending more attractive or necessary. Meanwhile, high-yield bonds, or those trade-exposed companies, could underperform if economic uncertainty picks up, rates rise further, or tariffs really hit. It acts as a kind of hedge.
Interesting. PNC potentially benefits from uncertainty while hedging against broader market fallout.
That's the concept. But again, purely speculative, just connecting some dots from the call. Definitely not advice. You absolutely need to do your own thorough research.
Absolutely. Always do your own homework. Okay, that wraps up our deep dive into PNC Financial Services Group's first quarter 2025 earnings call.
We've distilled those key points, hopefully giving you a clear picture of their performance and outlook.
What stood out most to you? It's worth thinking about the results and the broader context. We definitely encourage you to explore further.
Thanks for joining us on Talk Tickers.
We'll catch you next time for another earnings call analysis.